A key metric that we like to talk about at the University of Wisconsin, especially for entrepreneurial firms, small businesses that have been around a while, mature, but you're still in the growth phase. We call it the sustainable growth rate. Now, the sustainable growth rate was the version we'll talk about was devised or developed by a professor out of the University of Washington, Bob Huggins. Huggins is an accounting professor, and he took the traditional return on equity sustainable growth rate, did some derivation to it to give us a little more, what I think is a more meaningful number for entrepreneurs. What the sustainable growth rate, or SGR percentage, will tell you is once you calculate it, it'll tell you that based upon the profit margin percentage, the amount of profits being retained in the business in relation to total income, the amount of leverage in the business, in other words, the liabilities to equity, and also the asset utilization or asset turnover. Once you've calculated these and plugged them into the formula, what is the percentage of growth of annual revenue growth that the firm can sustain based upon maintaining these ratios? What it does is once you've calculated the percentage, it helps you compare to what your actual growth rate is. It may tell you you could grow a lot faster, grow your sales much more on an annual basis, or maybe you're growing too fast, or the actual historic rate is greater than what you can handle, so you're going to have to make some changes in order to increase or change your growth. Now, the growth formula, the sustainable growth rate formula, is pretty straightforward. The four components, as mentioned: profit margin is just net income divided by your annual sales. Your earnings retention rate is just 1 divided by the 1 minus dividends divided by income, or just simply the percentage of profits that are retained in the business. Leverage can be calculated a couple different ways. I use total liabilities divided by owner's equity. And then asset turnover is simply the inverse of the traditional sales turnover ratio. In other words, assets divided by sales. Plugging it into the formula, you'll see in the numerator it's simply the profit margin, how much money the firm is making on a percentage basis in relation to annual sales, times what's being kept in the business, times the impact of 1 plus leverage. All divided by the asset turnover minus the numerator. Plugging in all those various ratios, you'll come up with a percentage, and that'll be your sustainable growth rate as a percentage of annual growth in sales. Now, a couple things to note. A lot of times with businesses, it may be very difficult to determine what is the actual dividend distribution in small businesses, especially older companies. If that number is hard to get at, or it seems a little unreasonable, we typically assume the average is that the amount of income distributed to owners is about 1/3 of net income goes to the owners as dividends. A second thing to note: companies that have a very, very low asset base to sales, in other words, like a lot of service firms and things, that will make the T very, very small, and which will lead to very, very high growth rates. So with service firms, you typically have to, it may be less applicable, and or you've got to compare service firms to service firms. Also, liabilities to equity, that can vary based upon making sure that the equity base has been adjusted for any major distributions over time, things of that nature, which comes into play with LLCs. But that's the sustainable growth rate formula.